Welcome back to TradeHive. I'm Britton Brown, been a trader for over 30 years. This is the weekly institutional positioning update where we look at the S&P and NASDAQ through the Commitment of Traders report and then blend the two together to understand the broader equity risk regime. If you're new to the framework, I've explained this in past videos, how we build the charts, and you can certainly go back and look at those. But today we're going to focus strictly on what the data is telling us right now. I'm going to flip over to the charts. This isn't going to be a long video, so we'll get cracking for you. Okay, on the left side, that chart on the left shows the ES COT chart. Starting with the S&P 500 futures, institutional asset managers remain heavily net long, which continues to provide underlying support for the market. However, this week we did some trimming of long exposure and see an increase in dealer hedging. Now, at the same time, leveraged funds covered a meaningful amount of short exposure. That's kind of important. That combination typically points to a market where the trend is still supported, but conviction is no longer accelerating. In other words, institutions still control risk, but the environment is becoming more selective rather than aggressive. On the right side, you'll see the NQ chart. Looking at the NASDAQ futures positioning, we see a similar structural picture. Asset managers remain net long, but they also trim some exposure this week. Dealer hedging is easing just slightly in the NASDAQ compared to the S&P, while leverage funds leaned a bit more defensive. That mixed behavior between the two indexes is something we often see during rotation phases rather than broad risk-off environments. I'm going to pull up the COT chart now for the blended COT TradeHive framework. When we blend the ES and the NQ together, the signal becomes very clear. Normalized participation actually expanded slightly this week, which is going to tell us capital is still involved in the market. And at the same time, blended big money pressure cooled modestly, but it remains above the bullish regime threshold. So the key takeaway for you is that institutions are still supporting the risk, but the momentum behind that support is flattening. On the bottom part of this chart, you'll see our TradeHive Risk Regime Index, and that reflects that shift. After holding steady at 62 for several weeks, the index slips slightly to 60. Now, that's not an alarm bell. That keeps us firmly in a late risk-on environment, but it also tells us the regime is stabilizing rather than expanding. So from an execution standpoint, the environment remains constructive, but traders should expect more rotations and fewer straight inline trends. This is typically where discipline and selectivity matter more than the actual aggression of trading. Right? So don't be chasing those trades that get away from you. Let them go. They're going to come back to you with a high probability. Now let me get out of here and we'll finish up. So we'll continue to update the blended ES and NASDAQ institutional framework each week so we can track how the regime evolves over time. Lastly, the individual reports are up on the website. I will leave links below so you can access them. And as a last bit of house cleaning, I want to pat myself on the back because if you caught the crude oil COT report last week on my website, along with my institutional framework that I put out on March 3rd for the crude oil, you would have enjoyed a $13 bull run this week. Now, how's that for doing some homework and giving you a look at how big money positions and how we can ride their coattails to the promised land? Until next time, thanks for watching, and I'll see you next week with the TradeHive update. Appreciate your time, guys.